The AI gold rush is no longer just about big tech's deep pockets. It's now a high-stakes game of debt and risk. But here's where it gets controversial. The companies fueling OpenAI's computing power have piled on a staggering $96 billion in debt, according to a Financial Times analysis. This raises a critical question: can the AI sector sustain its breakneck growth without collapsing under its own financial weight? And this is the part most people miss. Even OpenAI, the poster child of AI innovation, is projected to fall $207 billion short of its funding needs by 2030, despite eye-popping revenue commitments. Let's break it down. OpenAI has pledged $1.4 trillion to secure the energy and computing resources it needs to dominate the future. Yet, it expects to generate just $20 billion in revenue this year, a fraction of what's required to keep the lights on. HSBC's recent analysis paints an even bleaker picture. Even if OpenAI hits $200 billion in revenue by 2030, it will still need an additional $207 billion to stay afloat. Meanwhile, the companies supplying OpenAI with data centers, chips, and processing power are drowning in debt. Here's the breakdown. $30 billion already borrowed by SoftBank, Oracle, and CoreWeave. $28 billion in loans taken by Blue Owl Capital and Crusoe. $38 billion in ongoing talks with Oracle, Vantage, and their banks. That's $96 billion in total, a figure that's hard to ignore. Here's the kicker: this debt-fueled expansion is a relatively new phenomenon. Until recently, AI projects were largely funded by the cash reserves of tech giants like Microsoft, Alphabet, Amazon, and Meta. But now, even the big five hyperscalers, Amazon, Google, Meta, Microsoft, and Oracle, have quadrupled their debt this year, adding $121 billion to fund AI operations. That's a seismic shift in how the industry is financing its ambitions. The ripple effects are already being felt in credit markets. Bank of America analysts Yuri Saliger and Sohyun Marie Lee note that investment-grade corporate debt issuance is surging, with hyperscalers and debt-funded M&A deals driving the increase. Deutsche Bank adds that credit default swap, CDS, spreads, essentially the market's fear gauge for corporate debt, are widening. For example, Oracle's 5-year CDS has jumped by 60 basis points since September, while CoreWeave's has skyrocketed by 280 basis points. But here's the million-dollar question: is this debt-driven AI boom sustainable, or are we witnessing a bubble waiting to burst? Critics argue that the sector's reliance on borrowed money could lead to a painful reckoning if revenues fail to materialize. Proponents, however, see it as a necessary investment in the future of technology. Take CoreWeave, for instance. The company reported $3.7 billion in current debt, $10.3 billion in non-current debt, and a staggering $39.1 billion in future lease agreements for data centers, all while expecting just $5 billion in revenue this year. How will it service this mountain of debt? Investors are watching closely, and the outcome could set the tone for the entire AI industry. Here's the bottom line: the AI revolution is no longer just about innovation, it's about financial engineering. As the sector leans heavier on debt, the risks are mounting. Will this strategy pay off, or will it end in tears? That's the trillion-dollar question. What do you think? Is the AI industry's debt-fueled growth a bold bet on the future, or a recipe for disaster? Let us know in the comments. We'd love to hear your take on this high-stakes gamble.